So, good afternoon, everyone. Welcome to this workshop on the policy paper on the future development of the EU forward market. We have this paper hosted today to present you the results of the policy paper that we drafted and recently published. And we have a full agenda, so to say. So. Quickly go into the opening today. On the opening, basically the context for this paper. So consider indeed forward electricity markets to be very important to further develop for carbon neutrality and indeed structural market shocks, and they increase the uncertainty in future electricity prices. And this indeed also led to growing importance of forward electricity markets, and they are indeed crucial to provide stability to stakeholders. These forward markets were assessed in the ACER policy paper we published, and the objective of this paper indeed are to identify main problems experienced in the EU electricity markets in the recent period, and indeed to identify possible solutions that policymakers could make to introduce to solve these problems. So today we'll go through the whole paper. We have a full schedule. We'll go through all the options that were assessed and indeed proposed in the paper. And have a response by stakeholders after those sessions. For asking questions, we use Slido. If you use Teams, you'll probably be able to see the Slido app on top. If not, there's a QR code along the way in the presentation, but the hashtag for Slido.com is @electricity forward market. So you can always find it there, submit your questions, and we'll moderate them and deal with them or answer them after every session. Slide pack will be shared with you after the webinar, and indeed also the recording will be made available online. The Slido will remain active until Friday, and indeed open questions will try to answer them as much as possible in Slido until Friday, before indeed closing the Slido. Then on the agenda, so we'll start with in session 1 with the problems statement and the objective of the paper, the general recommendations, and the preferred policy options on the coordinated NRA decisions and the improved access to long-term transition rights. Then we'll have a 10-minute Q&A session, followed by session 2 on the 3rd, 4th, and 5th policy option, firmness, and indeed remaining risks and challenges. Also followed with a Q&A session. And then in session 3, we'll have stakeholders view, ENSUI, Europex, and market participants presenting on their behalf response to the policy paper. And then at the end, we'll close off with Anne Rademacher from the European Commission and Christian for their closing remarks. That leads me to the first session, and I give the word to Martin, who will present the problem statements and objectives.
Yeah, sorry. Thank you, Mathieu. I'm Martin Poe from ACER. I will present how we define the problems and objectives for the evaluation of the policy options. So we starting with the first problem, we see that forward market, and that's the most important problem we identify. The forward markets are very much fragmented in Europe. We see much forward trading in some, let's say, larger bidding zones or larger hubs, but there is still some significant trading and liquidity in smaller hubs, smaller bidding zones. And we see this as a sort of lack of opportunity. Why not combining all this trading in the same location, in the same hubs? So what we see, unfortunately, that the forward market still works similarly as the day-ahead market worked like 15 years ago before any market coupling was introduced. And 15 years ago, we see day-ahead markets being very illiquid in the small zones. But today, after coupling, we see that liquidity in day-ahead, even in small zones, is not an issue because with the market coupling, and we have integrated in the markets in a way which helps liquidity in all bidding zones, not just the big ones. So that's the first problem we identified and the most significant one. Other problems we see in the forward market is the hedging disincentives. So we see that there are lots of mechanisms imposed by member states or other parties which take away the incentive to hedge, like the capacity remuneration mechanism, like state contracts like CFDs or renewable subsidies. So all these contracts take away the need to hedge, and they are reducing the liquidity in the forward market. One element we also see is the collateral requirements. They have been increased in 2016-17. And since then, this also provides stronger disincentive to go to organized power exchange to trade and move more trade to bilateral markets. That was also had a negative effect on the forward market. Problem 3, we see the market structure sometimes is reducing the forward market liquidity, particularly when there is high concentration on supply and demand, or where there is supply-demand asymmetry. Some bidding zones have more demand and less supply, and some have more supply and less demand, and this can affect the liquidity of the forward market. Problem 4, we see that forward markets are vulnerable to bidding zone reconfiguration. This works both ways. So when we do the bidding zone reconfiguration, this discussion always stops at the fact that we're gonna hamper the forward market, and vice versa. If we would actually have to change the bidding zones, we would significantly affect negatively the forward market. So these two items are tightly correlated, and they need to be. The issue is that they don't have to be that much correlated. There are ways to decorrelate them. Problem 5 we identified, and those problems are more related to the transmission rights. So the first 4 problems are more like a general forward market problems, and the remaining problems are more about the transmission rights. What we see in the transmission rights market is that they contribute to market fragmentation. They don't actually are helpful to integrate the market. So because they are not able to, in a structured way to match supply and demand from different bidding zones. And that's why they do help the forward market, but not as much as they could. So problem 6, we see that those transmission rights are not accessible enough. They cannot be accessed on a continuous basis or very frequently, as, for example, the forward products, futures, options should be able to. So they are therefore not able to satisfy demand when if you want to go for proxy hedging, and if you can't acquire transmission rights to cover the remaining risk, then this proxy hedging doesn't. Transmission rights are not helping this proxy hedging. Problem 7 we see is that these transmission rights have inadequate maturities. So at the moment they are only allocated up to 1 year ahead. But we see that in forward market there is a demand and supply for hedging at least up to 3 years ahead. Not in all markets, but in the most liquid markets we see that liquidity up to 3 years ahead, and it would be beneficial if also transmission rights would be allocated at least in the same time frame. That's one problem we see as well. And the last 2 problems we see is more from a regulatory perspective and TSO perspective. We see that transmission rights are continuously undersold, and we see that if we measure the ex post risk premia. So we compared ex post what is the auction price received for the transmission rights and what are the actual payout or the remuneration. And if you look this indicator over a very long period, like 5 or 10 years, we see that on average, transmission rights always lead to negative outcome for TSOs, which means TSOs receive less congestion income than what they have to pay out, and this impact is quite significant. It's not negligible, and that's something we also aim to address. And finally, the problem 9 we see with the legal framework by which NREs can give exemptions to TSOs when offering transmission rights. For the moment, these exemptions for TSOs are given on a bilateral border-wise basis, and this framework is not transparent, it's not harmonized, and we see this as one of the issues which are causing friction in the transmission rights framework. So on the problem definition, we received a couple of comments from the consultation. The most important one is that in the consultation version, we focused mostly on transmission rights, and we recognize this problem. That's why we expanded, as you see, the problem definition. We also included other more general problems in the forward market, so that the problem definition is more I would say holistic in the latest paper. The second question, we see that forward market liquidity is not a barrier to reconfiguration, but only a criteria to consider in the bidding zone review process. Here we would tend to disagree. We see a very strong interdependence of both topics, and we cannot deny it. So forward market is endangering bidding zone review, and bidding zone review is endangering the forward market liquidity. But the point we're trying to make, it doesn't have to be that way. There are solutions which could disentangle those two problems and treat them separately. The third comment we receive, which is quite often, is that transmission rights are not the main hedging products, that they can only be used for proxy hedging. I think we agree on that. Transmission rights should be ideally helpful for proxy hedging. On this we fully agree. Then the comment we received that FTR options should be offered as a minimum by TSOs and obligations can be offered by exchanges. I think we consider that FTR obligations are, in terms of the model we propose, have better qualities than the options, and they can make forward market more efficient. But we will come to that topic in the second part of the consultation, where the options versus obligations is specifically addressed. And the final main response we got is that transmission right valuation should be based on forward market spread at the time of auction and not on the ex post risk premium. So indeed, so the ex post risk premium can be seen as biased. You know, if you look at specific month or year, of course, the risk ex post, the prices are always different than the forecasted prices. But if you look at the ex post risk premium over a very long period, like 5 to 10 years, where we have many auctions, many forecasts, many realized prices, we can make certain conclusions, and we see that, you know, in 5-10 years time frame, that this risk premium is always negative. We have also done some short analysis on forward spreads, so we'll be comparing the forward spread versus auction prices, and even there we see undervaluation. So it's not confirmed only with one indicator; it's confirmed with 2 indicators. When we addressed these problems, we had certain assessment framework. So we defined the policy options and then evaluate these policy options against certain assessment framework. And here we use the assessment framework, which is typically used in the impact assessment by the Commission. And what we assess is that we assess policy options against 6 criteria. So effectiveness to enhance market integration, so to establish common market rules and harmonization, effectiveness to ensure non-discrimination, in particular non-discrimination among stakeholders and market participants, effectiveness to increase competition, so to reduce entry barriers and making hedging products more competitive, then effectiveness to enhance efficient market functioning, so how does the overall market function, does it function efficiently? And finally, we have a criterion on efficiency. So is the policy option having positive cost-benefit outcome? And finally, coherency, is the policy option coherent with the energy markets and other EU policy objectives, and as well as existing legislation and so on. So does it fit to the current framework? So we took this criteria, and the evaluation approach, as just briefly summarized. So we have identified the problem. We tried to identify what are the objectives against which we will assess the policy options. Then we identify which policy options exist, which policy options are able to address the problems. And then once we have these policy options, we evaluate them and then conclude on the most suitable policy option. In this case, I would give now the floor to my colleague Thomas to present the first part of the policy options.
Thank you, Martin, and good afternoon to everyone. So indeed, in that section, we'll dive into the preferred policy options. We'll first start with some general recommendations and then present two policy options. The first one on how the NRA takes decisions on the TSO's exemptions, and the second on the improved allocation of long-term transmission rights. So as presented by Martin, the problems are divided in two categories. And indeed, we observed that for some of the problems, we as energy regulator can directly address them. And those are the ones that are discussed in the following slides. But some problems are outside the competence of energy regulators, or for those problems, some dedicated solutions already exist and would need to be applied. And therefore, for the second category, we provide general recommendations, which are listed here on the slide. So to address the high market concentration that we observe, whether it's vertical or horizontal, we recommend to improve the market structure and to promote competition. This can be done also by removing entry barriers. The second point is about the reduction of hedging disincentive. We know that some regulatory interventions on the very long term, and we target here, for example, contract for differences or capacity remuneration mechanisms, can minimize, can have an impact on the hedging incentives. And we would like that those interventions are designed in a way that minimizes their impacts. All in all, we do not want to take away all the risk of the investors. The third point is that we recommend to work on the reconfiguration of the bidding zones through the existing bidding zone review process. It's a process that is aimed at assessing all the aspects of bidding zone sizing, so not only short-term efficiency or not only forward market liquidity, but all aspects. And therefore, we recommend to follow that process to discuss a potential reconfiguration of bidding zones. The fourth point is about the reduction of the barriers to trade at organized marketplaces. And here we specifically tackle the point of the collaterals heavily discussed over the last month, for example, by recommending to review the collateral schemes that needs to be placed for the forward markets, for example, through non-fully backed bank guarantees. So after the general recommendations, we can dive into the first preferred policy option. As said, it's a policy option that targets how the decisions are taken by NRAs on the exemptions for TSOs to support or not the forward market. And more specifically, here we target or we prefer a coordinated decision. Indeed, in the current framework, those decisions are taken nationally by individual NRAs. And in a context of cross-border hedging or cross-border support, we believe that a coordinated decision makes more sense. So what we preferring that option is that TSOs are generally required to allocate long-term transmission rights. It is the default option. However, NRAs may decide either that the TSOs have equivalent measures in place. We can, for example, think of what the Nordic region currently have with the EPADs, or that the TSOs are exempted from supporting the forward market. This option would be subject to an assessment that the forward markets work well without the TSO support and would be backed by a transparent and precise matrix. So here, the main aspect is that the decision is taken jointly by NRAs in a region, and that LTTRs are the default option, and that there can be other alternatives. Moving to the second preferred policy option, here we call this option improved allocation. We target here the allocation of long-term transmission rights, LTTRs, and we prefer to improve it through 4 different sub-measures that are listed here. The first one is to issue longer-term products. So transmission rights are currently issued up to 1 year ahead. We would prefer to have them issued up to 3 years ahead. Same for the frequency of the auctions. Currently, the LTTR products are auctioned either monthly or yearly, depending on the product. We would like to have a more frequent auctioning up to a daily granularity. Third point is how the transmission capacity or the LTTR capacity is calculated. We currently calculate it based on scenarios. We would like to move that towards something statistical, which would be based on the historical distribution of the day-ahead offered capacity. And the fourth and last point here is that we would like to have a continuous access to a secondary market for transmission rights, which would include any capacity left over. So quite a lot of changes compared to the existing LTTR allocation, which are all under this single option of the improved allocation. And what we can see on the bottom of the slide is an example. We were in the date of the 4th April, and we can see which products are available for that specific date. So we have monthly products up to the end of the year, so from May onwards. We have quarterly products for the 2 full quarters remaining that year, but also quarterly product for the year after, and then also a yearly product up to year +3. So quite a lot of products that would be auctioned on a weekly basis. We now zoom a bit further on how the capacity calculation would work. As said, it would be a transition towards a statistical approach. And what we would like this approach to be based on is the historical distribution of offered day-ahead capacity. So we would draw a margin, a very high one, for example, 95%, ensuring that the offered day-ahead capacity is greater than the long-term capacity. Why is that? It's because we want to limit the risk of revenue inadequacy for the TSO, and this risk can occur in case the long-term capacity is higher than the day-ahead capacity, and at the same time that the day-ahead price is lower than the long-term transmission right price. So this is something we want to mitigate. So to mitigate that, we can play with the value X that I mentioned earlier. It's something that is that could be changed if we observe a higher risk than of inadequacy, and therefore we can adapt it to mitigate that risk. But also we should ensure through the FCA regulation that there is full cost recovery confront for the TSOs in case this inadequacy still occur at an annual level. So quite a big change, the transition from scenario-based to statistical approach, but we consider it to be very important, especially if we want to issue product up to 3 years ahead. And here on this slide, we have examples to show or try to have a first idea of the value of the capacities that could be issued. So I invite you to look at the table where we have 4 example borders. And for each border, we have a few values. So in the first column, we have the currently offered day-ahead capacity. So it's a conversion to NTC data. We know that those borders are in a flow-based environment. So we have values that are approaching what is currently offered. On the second column, we have the currently offered transmission rate capacity. And we can see that between the first and the second column, we can have some high differences in the values, whether it's upward or downward. And in the third column, we have an estimation of what could be the newly proposed long-term transmission rate capacity, taking the value of 70% of the day-ahead capacity, which we think respects the risk criteria that I mentioned earlier. And so we can see that for most of the borders, this is either small, but can also be a major increase of the offered transmission rate capacity. And therefore, we think it's an important change to include in this improved allocation option. And the last column shows a first proposition of how the capacity could be split across the different auctions. I mentioned weekly auctions. And if we propose to have an equal part of the capacity allocated in every of those auctions, we have the values that are on the last column, which would be quite small values. But as you will see in the next preferred policy options, we think that those values are used to support exchanges of transmission rates between market participants and are not to be considered as the transmission rates that are currently auctioned. So that was it for these general recommendations, first and second preferred policy option. And then I will give the floor back to Mathieu now for the first Q&A session.
Thank you, Thomas. Timely as ever. Just let me. So I have a number of questions, and I need to. So, Thomas, Martin, I labeled them, and I think you can see the labeling. But I don't think I can filter them so you can see the filtering. So I will just go top to bottom, which might mean that we go a bit between the different topics, but probably best to do it in that way. So, and just to check with you, see the top question being a question on Zone to Hub LTTRs, right? Now.
Indeed.
I propose to skip that one because was a bit out of place. So maybe to go with the one below on the main difference between the day ahead and the forward market integration. Is that market participants from a liquid market did not trade in more liquid ones before they had integration? In forward, all EU market participants trade in a German hub. Isn't that enough for integration?
Yeah,
I don't know who wants to take that. Yeah, Martin.
I can take that one. So
Yes.
indeed, so the situation is not entirely not integrated. So there is a lot of trade happening in certain hubs like Germany, but there is still significant trade happening outside Germany. Like if you look at the first graph we showed, there's trading in Belgium, in Netherlands, in France, in Czech Republic, in Poland. So and I don't have the exact number, but roughly about 50% or more of volume is still traded locally in those bidding zones, and there we see the room and opportunity to combine these local volumes and German volume into one hub. That's where we see still the need for further integration.
Good, thank you. Maybe then I see a question on the improved allocation on the statistical approach. So how does it fit the flow-based long-term capacity calculations CSOs are working on? It's got 11 votes. So
indeed, that's a very relevant question. I will take it. The current long-term flow-based capacity calculation methodologies are based on scenarios. So those this switch to a statistical approach would mean that we would shift or transition from what is currently being worked on to something new. However, from a timeline perspective, we still expect that those flow-based capacity calculation methodologies would be used for a few years. However, I would still like to remind that we only speak about the calculation, but the allocation part will remain valid. It's not because we move from scenario to statistical for the capacity calculation that the allocation is touched.
Thank you, Thomas. I propose to skip this one as well on the FTR obligation. So go to the next general question, which is about the problem of fragmentation. Is the fact that the grid is not and will never be a copper plate. And with the increase of renewables, the problem will increase more and more. So how do ACER want to consider in the future the reality of the physics?
Maybe I can take that one. So the point indeed is the hubs work well when there is no congestion. So like the TTF, TTF work very well when there is no congestion, but in the last year or half a year, when there were significant congestions, TTF was less optimal as a proxy hedge. But here in the electricity sector, we have congestions always. And here what we want to emphasize is that hub always needs to be complemented by transmission rights or EPADs or CFDs, however we call them. But there needs to be a liquid market for products which can bridge the hub and each bidding zone. And this is essential. So whatever model we propose, it fundamentally depends on this transmission rights or EPAD market. These EPADs have to be accessible liquid to be able for the hub to be able to work.
Good. Thank you, Martin. Then I have a next question, which is indeed quite short, but it's indeed on the question whether it would not be better to label the liquidity of the German market as moderate instead of good. I don't know who wants to take that one.
Maybe I can start, but so indeed the question is, what is moderate good? What is the churn rate? To which demand do you divide? If you divide the trading in Netherlands with the Dutch demand, it's gonna be different churn rate than if you divide the German hub with the German demand. But we don't want to enter the discussion. It's moderate good. We think it's rather good, but it can be still improved if we combine, as I said before, if we combine all the liquidity of neighboring bidding zones, which is still occurring, into the let's say regional hub. But for us, it's less important how do we label it.
Good. Then another general question. I think looking at time, yeah. Let's take two or three more general questions and move to the improved allocation questions, which were also some on that. Yeah, maybe this first on the policy evaluation, whether there's been any assessment of the potential negative impact on forward markets for energy or cross-zonal hedging, FTRs or other. I hope you can make something out of this question.
If I understand correctly, the question the question asks, did we assess negative impacts on policy options on the forward market or cross-zonal hedging? So indeed, some policy options have we have positive or negative, and some policy options do have negative impact on the hedging. For example, if you just switch from zone to zone transmission rights, we would significantly fragment the market, and by that we wouldn't contribute to competition. So some policy options do have negative impact, unfortunately. Yeah. That's why we didn't choose them.
Okay, good. Thank you. Sorry, just that one. Yeah. Let me close that one. And I have another one. Maybe that's then the last one on the evaluation of the objectives. In evaluating objectives, consideration should be given to effective competition in retail markets. An absence of effective LTTR rights is a barrier to retail competitions from our participants who do not have generation within the price area. Or maybe the question was, did we consider this in the assessment?
I think that we considered both. So the contribution to competition, we meant both wholesale and retail. So and entry barriers, we mean both wholesale and retail. So we do understand that forward market benefit retail competition as well, and entry barriers to retail markets, and this was part of the evaluation as well. Yeah.
Thank you. Then I would start with maybe some questions on the improved allocation topic that Thomas introduced. And I see a first question on that, scoring very high on the question how capacity is split between the different timeframes. Probably in this new proposal, so between years, months, and quarters.
Yes, so this is a topic that is not set yet. This is something that would be subject to further studies and also a methodology. In the slide I presented and also in the paper, we suggest to start from an equal split between every auction, meaning that a yearly product would be 52 times the capacity of a weekly product. But for now, this is something that is not set yet and subject to further discussion and assessment.
Thank you. Then another one on the, which I think is a bit of the same question. It's a bit further down. What volumes of capacity to be issued by TSOs for weekly or daily auctions? Judging by the current volume auction by TSOs, it would mean single-digit capacity in daily auction. I think we did something on that, right? Yeah.
Indeed, and I'm moving back to the previous slides. On the last column, this is indeed what we foresee as a weekly volume based on a first estimation of this statistical capacity calculation approach. I see the question that an anonymous person suggested that it would be single digits. It can be sometimes 2 digits, but indeed it is quite low. But we need to remember that it is a weekly auctioning process, and that the capacity is there to support FTR trading and not to allocate products as it is done currently. So it's to be considered a bit differently as well.
Maybe just to add, and we will come to that later. In the concept we propose, this is just a basic liquidity. TSOs inject basic liquidity by offering capacity. But we expect this liquidity to triple or quadruple, or because we can have also trading inside the zones for transmission rights. Market participants can sell or buy, and we expect the actual volume of transmission rights being traded will be multiple of the capacity the TSOs are offering.
Thank you, Martin. Maybe, and I'm looking at time, but indeed another one, which indeed is on the implementation timeline. So how long it would take for the TSOs to implement the proposed variety of products, respectively how to start such auctions. Whether we have an opinion on that?
I would say it's a bit early to provide any precise information on that.
Yes.
This is only a policy paper suggesting policy options. There would be a whole regulatory process that would need to take place before we can think of that.
Just to calm you, that we are talking about the timeframes 5 years plus minus a year or two, more plus. Yeah.
Good. I see that the question disappeared. Oh no, here it is. Sorry, trying to close it, but it's dropped. Maybe one final question, which I think scored quite high with 6 votes. Stephen Woolthouse asking, Commission Industries and Market Design Consultation recognize the importance of cross-border intraday trading. Do these proposals encompass intraday and balancing timeframe, or are we just thinking about day ahead? How will transmission rights for flexibility service be taken forward? Quite a general question. I don't know, Martin, if you want to give that one a try.
Yeah, so I understand where the question comes from. There was a historical discussion on reserving some capacity in the day-ahead time frame for the intraday. I just have to say this is not that topic. So that topic will be visited in another discussion, maybe in the market design discussion. But here we are only talking about the long-term capacity allocation. So multiple years ahead, year ahead, month ahead. We are not looking into day ahead versus intraday. That's not in the scope now.
Okay, good. Okay, good. Thank you. Art, I would propose we close and indeed go to the next set of policy options.
Perfect. Thank you, Mathieu, and it will be me again for this section. So here we zoom on two other preferred policy options, the zone to hub long-term transmission rights and the market making. I would say that the preferred policy option 3 is the biggest chunk of the propositions, but it is to be considered together with all the other ones that we prefer as a whole. So the change that we would introduce with that preferred policy option is that there would be a transition to hub-based hedging. This hub-based hedging would be complemented with zone-to-hub transmission rights. What is important to consider here is that the transition is voluntary. We're not forcing any exchange to list hub-based products. There is no new obligation, but we would incentivize the trading at the hub through a design of the transmission rights. So the transmission rights that the TSO issue would be issued in the form of zone-to-hub transmission rights. Those transmission rights would be issued as obligations. This is the preferred option for now. And the definition of that hub would be done at a regional level, at a CCR level. But two regions could form the same hub. That's a bit what we try to show with the example on the right part of the slides. We have the core member states in blue, but Italy is also here shown as within the hub. So this is just an example, but we want to open the possibility for member states outside ACER to still join a hub if the correlations are deemed good enough. And as already introduced in the preferred policy option 1, there is a possibility for a region to decide to go for an alternative to long-term transmission rights. And we could foresee that that alternative is what we call coupling with the CFDs. We need to think of CFDs more the way the EPADs are currently issued in the Nordic markets, but this option would imply a change compared to the transmission right options in the form of which party would be the counterparty for those products, whether it's the single allocation platform as currently done for the transmission rights, and also that's what we intend to continue with in the future, or a market coupling operator. So a very important point for those hubs to pick up the liquidity of the zones. As said, the transition is voluntary, but we expect that two elements incentivize the market participant to trade at the hub. The first one is the design of the transmission rights, and the second one is how the price of the hub is formed, and to which extent the hub can show good enough correlations between the price of the zone of a participant, and so that's what we show in this slide. We made some first simulations on what could the price of a core hub look like. So we computed it in this example as the volume weighted average of the day ahead price based on the hourly traded volumes. So we looked at the hourly traded volumes for every zone, the hourly price of every zone, and we made an average of that, which created a core hub price. And so in the table here, you can see that for 2022, the core hub shows better price correlations than the German price. So why Germany? Germany, we saw it in the churn rates that it shows, has a higher liquidity than other zones, and is implicitly used as a trading hub by some market participants. So we wanted to compare that German hub correlation to the core hub that we would create, and we see that for every zone, to the exception of Germany, which is quite normal, and Poland by just a bit, all bidding zones would show better price correlations. So for the color codes, we consider that everything that is above 95% is a good correlation. So in black, everything that is between 90 and 95 is in orange, and everything that is below 90 is in red. So we can see that we have a vast improvement compared to the current situation with Germany being an implicit hub. But we have an example to show a bit how it would work. In this example, we start with 4 stakeholders in Germany, Hungary, the Netherlands, and France, 2 producers and 2 consumers. Then we have a market setup where we have the core hub. Why we have only 2 arrows between France and Hungary, you will see just after. It's because the capacity will be allocated between those 2 zones, and we have expectations on the market conditions. We expect that Germany and the Netherlands show good correlations to the core hub, so in green, and France and Hungary a bit lower correlations. And in terms of expectation on the price difference, France is expected to have a price 8 euros higher than the hub price, and Hungary 3 euros lower. So now we will look at every participant to see what they would do to hedge. So the market participant 1, a producer in Germany, has a good correlation to the hub in terms of price, and therefore this participant will sell hub future and does not need financial transmission rights. This participant considers that the cross-border risk between the price of its zone and the price of the hub is sufficiently low, so it does not need any FTR. The second market participant, MP2, again a producer located in Hungary, does not have a good enough correlation to the hub. The forecast of the price of Hungary is €3 below the forecasted hub price, and therefore the market participant will rely on 2 separate products to hedge. First, it will, or in parallel, it will sell hub futures and then sell financial transmission rights from the hub to Hungary at a price of minus €3 per megawatt. We considered here that there is no risk premium. We just have a pricing at the expected price difference. And the same for the consumers with the opposite behavior. MP3, a consumer in Netherlands, will just buy hub future without any FTRs, considering that the risk is low enough. And MP4 will need to both buy hub future and buy FTRs from hub to France. So what is happening in terms of allocation is that there is an allocation between the MP2 and MP4. This allocation will need to respect the capacity constraints between those zones. And looking at the price at which those 2 participants have bid, we see that the TSOs would receive €11 per megawatt, so 8 plus 3 euro of congestion income from this allocation. So the important point is that MP2 and MP4 are buying and selling between themselves, and the TSOs are allocating capacity to bridge the difference in behavior between the different zones. In this slide, we do a small recap on what would be the products being proposed and how the matching would be done. So as said, we would rely on a single allocation platform, which would offer zone-to-hub FTR obligations for every zone. They could be either bought or sold. And the market participant would still have the possibility to buy zone-to-zone products by linking 2 products. That's an important point because it means that the market participant would still be able to bid in the same way as they're currently doing with zonal financial transmission rights as they're currently doing. And in terms of matching, zone-to-hub products are matched one with another if a buy order is matched with a sell order in the same zone. It's a so-called local matching. Or if a buy order is matched with a sell order in a different zone by allocating cross-zonal capacity. And for the zone-to-zone products, they are cleared if they are more competitive than the bids competing for the same capacity. But we also need to have enough capacity between the 2 zones. As said, the participants do not receive the FTRs directly from the TSOs. They buy it between market participants, and capacity is only there to allow matching between participants in 2 different zones. And in terms of auction setup, we foresee to have one auction each week with new capacity, also leftovers and resold capacity. And we would have in between those weekly auctions, daily auctions with capacity leftovers and resold capacity. To show a bit with a concrete example, we have currently a pilot project organized by Svenska Kraftnät, a Swedish TSO, which is involving allocation of capacity to support the CFD, so the contract for difference, or EPAD products. And this pilot was launched this year in February to support the liquidity of the EPAD markets. And so cross-border capacity is allocated to bridge the supply-demand asymmetry of the different Swedish zones. Indeed, that's something that has been observed in the different bidding zones of Sweden. There are different willingness either to buy or to sell, and therefore to bridge this asymmetry in between the different zones, capacity is allocated. And the first results show that the allocated capacity successfully supports the EPAD market, and that the results are in line with the parallel continuous market prices. So that's a pilot project, but we think it's a good example to show how cross-border capacity is allocated to support transmission rights products. Looking at the evaluation of the public consultation, we identified three main elements that were shared by the stakeholders. First, that the proposal is unlikely to solve the problem of liquidity in the individual bidding zones, that the hub might be liquid, but then participants will still have exposure in the bidding zones. So we evaluate that response saying that we think that many zones will have good correlations to the hub. We show that with the results, and those zones might not need to rely on financial transmission rights to cover remaining risks. That we will have more capacity that will be used to facilitate the liquidity of the financial transmission rights between the non-correlated zones, and by allowing market participants to both buy and sell financial transmission rights, and TSOs there just to support or to bridge the gap between the willingness to buy and sell. There will be a significant boost to the liquidity of the financial transmission rights. Then a second comment on the Nordic market, in which we have a virtual trading hub, saying that the solution proved itself not to be suitable considering the price difference between the different zones. We look at it a bit differently, saying that if we did not have a hub in the Nordics, it would have been much worse. So we think that the hub is the only viable solution for hedging in the Nordic market, and that we also think that an issue of the Nordic market is linked to the fact that there is no capacity that is allocated to support the impacts and their liquidity, and that if TSOs were doing it, it would improve the market functioning. And then a general comment on the fact that many design elements will still need to be defined, how the hub price will be defined, the structure of the hub interactions. This is something we fully acknowledge. This is something that will be further studied at further steps of the process, and those elements will be part of methodologies that will be consulted upon. Then a very last slide here before giving the words to Martin on market making. This is another preferred policy option. Following a national decisions, we also would like to foresee the possibility for TSOs to organize the nomination of a market maker, which would complement the liquidity of the transmission rights or the EPADs, and those market makers would be placing bids to reduce the bid-ask spread. It's a bit what we show in the example on the right, where the market maker supports the reduction of the bid-ask spread from 10 to 2, and a fee will be charged for this service, which will be covered from network tariffs and defined in tendering conditions. So we do not foresee any market making obligation. We just want to open this possibility in the markets for which it would be needed or helpful. And with that, I will give the floor back to Martin for the last content section. Thank you.
Thank you, Thomas. So indeed, in the last section, I will propose the last policy option and then some conclusions and some challenges, some critique as well we received. So first, on the last policy options, we prefer to go to FTR obligations with full financial firmness. So we had a long debate internally with NRAs and stakeholders on FTR options versus FTR obligations. And we have a preference for FTR obligations for the following reasons. So first, FTR obligations provide full hedge, meaning full price lock-in or the price difference lock-in at the lowest cost. So they are much cheaper compared to options. So they, this impacts the collateral requirements, impacts the, how accessible these are for smaller participants because they are cheaper. But of course they come with a higher risk, because so higher risk comes at a lower cost, or lower risk comes at a higher cost. There is a trade-off here. Second element, FTR obligations are easier to estimate. So if you value FTR obligations, you only need to deduct to base load prices. But if you want to value options, you need to forecast hourly values for the whole year, and that's more difficult to estimate for stakeholders, for smaller participants, but also more difficult to estimate for regulators and TSOs when we monitor and benchmark the values of these transmission rights. FTR obligations enable easier arbitrage. So if you arbitrage between two forward markets, then FTR obligations is quite straightforward. With options, such arbitrage is a bit more tricky to do. FTR obligations, that is very important. They enable better capacity allocation. So we expect more capacity because FTR obligations can be netted. In the context of flow-based, that's very important. So if you have FTR obligations in a certain direction, then you can allocate more in the opposite direction. And more importantly, FTR obligations enable capacity leftovers. So if you would have FTR options, there is no room for having auctions or continuous trading with capacity leftovers, because there are no capacity leftovers in case of FTR options. And that's very important for secondary market in case we want to use capacity leftovers. The fifth element, FTR obligations would concentrate liquidity into single product per zone. So this would imply more competition in the primary and secondary market because we have only one product per bidding zone. Currently, if you look at the core plus Italy North, with the FTRs, PTRs, we have 42 different FTRs or PTRs, so 42 different products, and there is no competition between them. With FTR obligations, we can reduce this to just 13, so one product per zone. That's significant, concentration of liquidity. And finally, what is important for regulators and TSOs, we expect FTR obligations would reduce undervaluation because of the above elements. We don't fully close the door on FTR options, but our concern is that FTR options would have a negative impact on the design that we propose. So because they would not provide these benefits that we propose here. So the second element of the FTRs is full financial firmness. So if we want these FTRs to be fully equivalent and compatible with financial forward products like futures, we need to have full financial firmness, which means no more exceptions to firmness. What does this mean? Which exception do we mean here? So first, we need to remove the notion of curtailment in normal situation. We need to remove the notion of curtailment in case of force majeure and emergency, because these are financial transmission rights, not physical transmission rights. We propose to remove any compensation cap, so no more compensation cap in under any conditions. We propose to remove the exemptions to LTTR remuneration. So there would be no exemptions in case of remuneration. We would have no more reduction periods, so there would be only base load FTRs. And on the LTA inclusion, so this is more also for the add capacity calculation, we would propose to remove the LTA inclusion in the add or maintain the LTA inclusion, but allow certain deviations in case of operational security. So this concern is that, if FTRs are to have no physical impact on the flows on operational security, then LTA inclusion would somehow contradict this notion. So for this reason, we indeed propose to go to a statistical approach to capacity calculation to minimize the likelihood of revenue inadequacy for TSOs. That's one important policy. And secondly, the new regulation should provide full cost recovery comfort for TSOs in case they would face revenue inadequacy on an annual level. So that's also very important. In terms of public consultation responses, we received quite a lot of concerns about FTR obligations. One concern is that FTR obligations would only make sense if participants would trade those between themselves, such as similar contracts in the exchanges. But in case it's offered by TSOs, then the options would be more suitable. And here, this question touches the essence of the proposal. Indeed, what we propose here is indeed TSOs would not be the issuer of transmission right, but TSO would only provide arbitrage between buy and sell demand and supply of transmission rights. So TSOs would only allocate cross-zonal capacity to be able to match buy and sell supply demand in different bidding zones of transmission rights. So this means transmission rights are being traded between participants, and TSOs only arbitrage with cross-zonal capacity. The second concern that FTR obligations lock the market and do not allow market participants to grasp opportunities in the way the options do. Here, what we want to emphasize that if we compare the financial market, or the financial electricity market, we see that futures are more preferred than options. So futures are equivalent to FTR obligations. They cover both positive and negative risk, and they are preferred. And we don't see why FTRs would be different with that regard. So why would FTR options be preferred, whereas in the financial market we see that futures are preferred and not options. So that's a bit of a question, but it's at least something we observe. The third question, the third comment we got is the FTR obligations would already exist under FCR regulation, and participants don't seem to be interested. So for the moment, we haven't offered them. TSOs are not offering them, so it's hard to conclude whether there would be actual interest, there would be actual trade. But again, I have to emphasize in the financial markets, futures are the preferred the preferred contract, and options are not the preferred contract. So the question is, why is the transmission rights market then totally different than futures market? And finally, the FTR obligations would increase the exposure. Indeed, FTR obligations come with higher exposure, but they also come with lower costs. So there is a trade-off to be made. So if you pay less, then you get higher exposure. But if you want to have lower exposure, then you need to pay more for these transmission rights. Now, so to conclude this presentation, we have summarized certain benefits and possible risks that we see in this approach. So what are the main benefits of the proposed hub model? Just to summarize. So we hope to achieve the pooling of liquidity. So instead of many national illiquid forward markets, we would want to gather all this liquidity at a regional hub. So as I said before, instead of having some trading in Belgium, Netherlands, and Czech Republic and Austria, why don't we merge all this trading in one single hub and pool the liquidity? Second, we hope to achieve more efficient hedge. So hub futures would provide better hedge for most zones than, for example, German futures. So mainly because there will be better correlation. So if we would have hub futures, those futures will provide better correlation, better hedge, better proxy for most of the bidding zones. Maybe a bit less for Germany, as we've shown before, but for most bidding zones, it will be a better hedge. This also means that transmission rights for many bidding zones will not be actually needed anymore because the hub futures will be providing the full hedge or good enough hedge. By combining all the liquidity of all core zones into one single hub, we can also hope to achieve a bit more market beyond 3 years ahead. We agree this is a hope, but if you have critical mass of liquidity in one place, you can have the hope to have a bit more liquidity even beyond that time frame. Fourth important element, we would have sort of disentangled the bidding zones from the forward market liquidity. Those two issues would be sort of independent, and one change does not affect the other, and vice versa. That's very important for the future development of the markets. Finally, we have to emphasize that we don't aim to force any power exchange or any participant to trade at any hub. So the trading and hubs will still be voluntary and what power exchanges offer. We just hope that because TSOs would offer transmission rights to a hub, we hope that a hub will become more attractive than currently the zonal futures. So that's why we sort of implicitly incentivize trading at the hub, but we are not forcing anybody to trade at the hub. That's very important to understand as well. With zone-to-hub transmission rights, what we hope to achieve is to have more continuous access. So we would hope to have transmission rights auctioned daily with capacity leftovers and weekly with new capacity, where a secondary market can be organized at exchanges, but maybe in future also the single allocation platform can organize the secondary market. It's a bit still open where would continuous secondary market take place. We hope to achieve less fragmentation because instead of today there are about 80 different transmission rights in the continent, we would have much less products and thereby more liquidity in those products. So we hope to achieve also more liquidity for transmission rights because market participants can also sell transmission rights. This is a very important change. Today participants can only buy and TSOs only sell. But by this model, we allow participants to buy and sell, and TSOs would only arbitrage between buy and sell by providing cross-zonal capacity. And by that, we hope to achieve more accessible transmission rights. Transmission rights would support hub futures up to 3 years ahead. There will be the same maturity, the same products. So you can buy 3-year ahead futures and 3-year ahead transmission right at the same time. And those products would correspond exactly. That's one of the intentions. And finally, with this model, we hope to reduce the problem of undervaluation. It's a significant problem for TSOs and regulators due to the reasons above. So to go to FTR obligations, to easier evaluation of FTRs, have regional competition of FTRs, and so on. So what are the remaining risks and challenges ahead if we go for that approach? So first, the question is, what if the liquidity at the hub does not develop? So what happens if nobody goes to the hub? In this case, this model also allows all participants to bid zone to zone. So if nobody goes to the hub, then all participants would just submit zone to zone bids like today. If you want to go from France to Germany, you can still submit bids from France to Germany. Instead of one contract, you will just receive 2 contracts, but you can still bid from zone to zone. So in this case, hub would become sort of like a failure, but the zone to zone transmission rights would still exist, and the existing model would still be possible. Full financial firmness on TSOs. TSOs will need to accept a bit more financial risks, and regulators would need to accept this risk in the network tariffs. That's a bit of a challenge for TSOs and NRAs. Statistical capacity calculation is also a new challenge. So how to define capacity with statistical approach, and then splitting them into the weekly portions. So that's also a challenge, but it's not undoable. So the JAW or the single allocation platform will have to change a bit because it will shift to daily auctions, secondary market. JAW will probably have to contract with some some clearing house to have more professional clearing for these transmission rights. The definition of hub prices, indeed, we need to define the methodologies, how to define these hub prices. This will be specific discussion and analysis, and involvement of stakeholders to define what is the correct reference price for the hub. In the smaller regions, for example, in the Southwest region or in the Baltic region, there is a dilemma. Do they establish their own hub, or do they just join the core hub or the Nordic hub? That's a bit a dilemma. We leave it open, but most likely it's better to join the bigger hub and offer transmission rights towards the bigger hub. And finally, there is one dilemma in the Nordic market, because currently Nordic market already has EPAT market. So the EPATs are traded at the exchange. So the question is, would the Nordic TSOs support existing EPAT market, or would they instead support zone-to-hub transmission rights? That's a bit an open question and a challenge. Finally, I would slightly visit the main criticism we received so far on the proposed model, try to address some of the main or the most often heard critique. First one, we have been asked why are we focusing so much on the undervaluation problem, and that we are sort of maximizing the TSO's congestion income. We are not trying to maximize TSO's congestion income. That's not the case, actually. We only want the transmission rights to receive the market value. And why do we want that? Because that's the indicator of the efficient market. So if the transmission rights receive the market value, this means that market is efficient and there is no risk-free profit, risk-free arbitrage. And indeed, there were some questions, it's just a redistribution of benefits from TSOs and tariff payers to market participants. But for us, it's very important that the congestion income is fully reflecting the value of zonal capacity, and this value has to go to the end consumers. It shouldn't stay with the participants. So the second critique we received is that a TSO should always allocate FTR options and not obligations. I think I addressed some of this already in the previous slides. We see numerous advantages with obligations, but the main concern we have is that with the options, the proposed model would be much less efficient and possibly even wouldn't work, because it would fragment the transmission rights. There wouldn't be any netting, there wouldn't be any capacity leftovers. So there wouldn't be any continuous market with capacity leftovers if we have options. So for a number of reasons, we believe that with FTR obligations, we can have better functioning forward market. But of course, we can continue the debate on that because I know it's a sensitive topic. The third criticism we often receive is that competition between the borders is not desirable. This relates to the flow-based allocation, which we have decided upon in the Nordic and the core region to go to flow-based capacity allocation in the long-term time frame. And the concern is that this allocation will provide no transmission rights or low transmission rights in the borders which have low spreads, so low price differences. Our response here would be that we deem it beneficial if more transmission rights is offered to bidding zone borders which have higher price differences. We deem this as a welcome outcome of competition. Mainly because we see that if bidding zone borders have higher price spreads, this also corresponds to the correlations between those borders are lower, and this means that more transmission rights are needed on that borders. And second argument I would emphasize here is that the transmission rights also means trading in forward time frame between the different bidding zones. And if we can have more trading between bidding zones which have higher price differences, this will also mean at the end lower prices for consumers and higher prices for producers in low price area. So enabling more trade between high price areas in forward time frame also means more benefits at the end for consumers and producers, because the price spreads will be reduced. The fourth criticism we have is that why, instead of going into this fundamental reform, why don't we keep the existing model and just do gradual or small improvements, like, for example, just offer more capacity, offer it for a longer time frame, and focus on secondary market. We have considered that approach, so being a bit more modest in the proposals. But what we see here is that the fundamental issue of integrating this forward markets in smaller zones would not be addressed. So we still don't see how we can combine supply and demand from many bidding zones into in the common market. And we see that today's explicit allocation of capacity is not an efficient way to integrate forward markets. So second element, explicit allocation, as today promotes bilateral trading, bilateral markets, but regulators would rather prefer to support trading on exchanges for a number of reasons. Most importantly, transparency and efficiency. Also, one element, if we stay with the current market, so zone to zone, the current market is too fragmented. So as I said before, there are about 80 different products in the EU. So secondary market will unlikely develop for the existing FTRs. So even if TSOs establish a platform for trading in the secondary market, we don't think this will help establishing secondary market for FTRs, because this market is just too fragmented to have any competition between FTRs. And finally, we see that the risk of state interventions with CFDs, CRMs, this risk is becoming even higher. So we will have more CFDs, more interventions, which take away the incentive to hedge. So it's even more important to, whatever incentive to hedge remains in the market, it's important to merge this supply and demand into the same product to the same markets. So we will probably have less incentives in the future. So it's even more important to integrate and merge this supply and demand. Last slide I have is that so the goal of the forward market is not to optimize the physical flows. We would tend to agree. We don't aim to optimize physical flows in the forward time frame. That's not the goal. Our goal is to merge supply and demand across different bidding zones, and we can do that with the help of cross-zonal capacity. That's the only objective we have. We don't want to just optimize the flows per se, but we want to merge supply and demand from many zones together. And finally, we heard some criticism that market integration is not the goal in the forward market. We would tend to disagree. So that we want market integration in all timeframes. And what we can also draw lessons from other markets. The forward markets can only work in hubs. So hubs are the way to go in the forward market. But in case we have congestions in electricity, we have significant congestions. This hub have to be complemented by some transmission rights. And that's why we focus a lot on how to make those transmission rights liquid, accessible, and by that we can enable these hubs also in our sector. I think I stop here and give the floor back to Matthew.
Thanks, Martin. Yes, thanks. Indeed, quickly getting into the Q&A session, and because we ran a bit over time, I propose we take a bit short, just to let everybody know. Indeed, a number of questions were already answered in the Slido, and we'll definitely answer any question that is still open. But I would at least take some very high scoring. Now we have the highest scoring questions still on, so maybe it's good to still take that one. So maybe to start with this first one, Martin, which is currently on top with 25 votes. Which saying, if the exchange believed the hub product was attractive to the market, they could introduce one, and they didn't. Did you discuss with exchanges why they believe this was not something the market wants? And why do you believe this will work anyway?
Yeah, very tricky question. So first response, an obvious one, is because nobody's offering CFD to such a hub. So, if you offer futures at a hub which has no complementary CFDs or transmission rights, obviously such a hub wouldn't be attractive. Because you cannot buy or sell products which can cover the remaining risk. By allowing this TSOs to offer that, we can make this hub more attractive. And second, I think that the power exchanges just they follow the demand or request from the market, what the markets want, where they want to hedge. And obviously the market didn't ask for a hedge at the hub because again there are no transmission rights toward the hub. So transmission rights are towards the zones, and that's why we have markets at the zones.
And maybe this links a bit to the next question, which is indeed about the Nordic model as a model for the virtual hub and the fact that the volume decreased there, which I think is also linked to this. Maybe you can take that again as well.
Maybe tomorrow you can do.
On that point, we try to answer that in the slide on the public consultation. We also observe that there is a decrease in the liquidity at the hub in the Nordics, also linked to financial regulation obligations, but also to a reduction of the correlations to the different zones. And we think that it is also because the EPAD product making the link between the zones and the hub are not supported with the transmission capacity. And this is a measure that could support the EPAD market, which would then support the trading at the Nordic hub.
Okay, good. Then indeed, the question is how do you expect to attract German market participants to the virtual hub since you add risk for them? And if German market participants are not trading there, how do you expect the others to trade in the virtual hub rather than Germany?
Yeah, that's a very difficult question. So what will the participants in Germany do? So you're right. So if Germany stays as it is, they will prefer the German market. So they will stay at the German market. We can expect maybe other bidding zones to go to the hub, but Germany, if nothing else happens, they will stay with the German market. So and there are two possible ways then how things could move to the hub. Either if Germany splits at some point, then the hub becomes an obvious choice. But if it doesn't split, probably then the German participants would switch to a hub only if the hub becomes more liquid than Germany. What I have to emphasize here is, if we achieve that, at least the Belgium, Dutch, Slovak, and if at least those bidding zones goes to the hub, we already have an added value. Maybe we will have then two hubs, maybe Germany, France, or three hubs, Germany, France, and hub. But it's still better than to have three hubs than having it 10 or 15. But indeed, we cannot force anybody to trade where they want. This will develop based on the demand and supply. But we think that, because all transmission rights would be linked to a hub, this will be enough attractive for most participants to go to the hub.
Very good. Thanks, Martin. Maybe then need maybe one on FTR obligations, which is a question about that FTR obligations were offered for some times on the Spain-Portugal border, and it stopped due to the lack of interest from market participants. And have you looked into this experiment and why FTR obligation would work now while it failed some years ago, as that was already in place at the time?
Yeah, on this, I have to admit we haven't followed this case. We also haven't discussed this with the Spanish colleagues from the regulators. So I cannot respond now. I would only speculate if I would respond. We need to look into this and maybe come back at some other point on this issue.
Good, thank you. And then maybe the last one, which I think is an interesting one indeed, on the physical location, whether the hub is linked to a physical location. Maybe to take that as a last one.
on that one, the hub will not be linked to any physical location. It is a virtual market reference, and therefore capacity calculation for transmission routes towards the hub or capacity allocation mostly will never be done from the zone to a hub. Allocation of capacity is only done from a zone to a zone, and therefore to allocate zone to hub products, we need to have two products that are merge into a single product. So zone to hub plus hub to zone equal zone to zone, and capacity takes place on a capacity allocation is done on that zone to zone product.
Okay, good. Thank you, Thomas. I think we need to stop. So indeed, stopping with the promise that all the questions that were not answered until now, we'll at least try to answer them either during today, during the workshop, or afterwards until Friday. I now go to, and I have control, right? Yes. So I now, before we go to the response, the stakeholder response session, I would like you to I introduce a poll which will run. The poll will run during the next half hour, so until the end of the workshop. And I think every 10 minutes I will start the new question. So the question is indeed whether stakeholder agrees that pooling liquidity at hub would be complemented, which would be complemented by accessible transmission right, would be beneficial. Then indeed a question on the main risk of the preferred policy options, which is an open text with the 2 words. I assume it's a bit more, but with a level of word maximum. And indeed, what are the main opportunities of the preferred policy option, which also indeed a open text. So I will run this poll in parallel. We'll get back to the results at the end. So you have some time to fill it in while we indeed also give the stakeholders the floor. And then indeed, I would go to the stakeholder session, and I think we start with Jim from ETSUI. And I will click the slides. So give me a hint when you want to move. Okay, can we hear you, Jim?
Yeah, can you hear me?
Yes, you're there.
Thank you, Matthew,
very good.
And
go
Thomas and Martin for the good presentation, and thanks for the opportunity to come and comment on the policy paper. My name is Jim Wilson. I'm the convener of market integration in SUI, and I will shortly present our view on policy paper. Next slide, please, Matthew. So what we have done is a little matrix where we do see where we agree and disagree with ACER on some of the points in the policy paper. So in terms of the issue or problem for the forward market, the Martin presented earlier, we do agree to most of it. As we've seen, we also see in the collaboration with the market participants that market participants are concerned with the falling liquidity in the forward market. What we do disagree, however, is though that we do see quite many details need further assessment. Specifically, we'll get into a little bit later, the maturity and sort of the harmonization. And Martin also mentioned that some of the issues in the forward market is the PPA and CFDs, and also the establishment of CRMs in some of the markets, which we also see as a concern, which hasn't really been highlighted in the policy paper. We also from ETSUI see a risk that the current products that are offered do not fit the new type of production, so the renewable energy production, when we are still offering baseload products, no matter what kind of policy options that are chosen. On the next point, we completely agree with ACER on the evaluation of LTTRs, that they are sold too cheap as it is right now. And of course, they come to a financial burden on the consumer or the tariff payers. On the next one, we also tend to agree on the allocation of longer-term timeframes. We can see that the market participants are requesting those, and we can also see that big products, also renewable products, need longer duration for hedging. So we do see that as a benefit. However, being a TSO, we are sort of concerned about how the not allocation, but calculation of the capacities will be done. If that should be in a statistical approach or a model-based approach, we don't have an answer, but we do see risk for that. And of course, it comes with other risks that we associate quite heavily with the TSOs. So sort of the dispatching cost could increase, and we are also afraid that this will have negative impact on liquidity, since we might not be able to allocate as much capacity as we do today. And then on the fourth one, the statistical capacity, there are both benefits and negatives with that, pros and cons. However, our biggest concern is once again, it was mentioned earlier, and we don't really see the need for long-term flow-based allocation if we use the statistical approach, but Martin explained it with competition, but we still have some current concerns about that as well. Next slide, please. Yeah, on the fifth one, we are still both pros and cons. But if we then go to the sixth one, which is for us the biggest hurdle to come over, throughout Martin's presentation was one recurring word, which was hope. And hope, that to me, it just says that we are very, very uncertain with this model. There are no evidence presented whatsoever that what we have been shown today is given. There's one word, once again, coming around, hope. We hope liquidity will increase. We hope this will happen. And we are very much uncertain. We are certain about the capacity calculation. We're also uncertain about the financial regulation. Is it still ACER who's going to regulate this, or are we turning into ESMA? Very big concern from us. We're also very concerned about the impact on already integrated market, the German forward market. How will that affect? How will the liquidity in that area be affected by a sold-to-hub model? And as said earlier, I mean, we're also still unsure how the capacity will be allocated, but Mark explained that it still will be between bidding zones. So maybe that is some comfort to us as TSOs, but still a lot of concerns. And the recurring word is, we hope this will be a good model. The last point is on the financial firmness. As of now, as Martin also explained earlier, the FCA code doesn't give us full cost recovery. And if we do implement full firmness, this will come at a cost for the tariff payers. And I just want to end the presentation by saying that from our side, from NTOE side, we're still evaluating possibly way forwards, not looking at the zone-to model, but other approaches. And we remain open for all discussions. If it's with ACER or the market participant or someone who wants to talk to us, of course, we would like to engage in those conversations. And I also must say there has been a very good interaction between us, the market participant, and ACER throughout this process. So thank you for having me.
Okay, thank you, Jim. Also thanks for sticking well to the time. We'll move to the next presentation. Is by Europex by Christine Doyle. Christine Doyle.
Yes, thank you, Mathieu. These are technical questions. I will have to say, please move forward if I want to switch slides, right? I'm going to do it myself. Okay, so next slide, please, Mathieu. And thank you very much indeed for the opportunity, and also for the good introduction and the good overview of what you provided us so far today. To start off, we really think that it's of high importance that we look into forward liquidity and actually value long-term forward hedging. I mean, we continue to have a discussion on a possible reconfiguration of bidding zones in Europe, and liquidity is always a major item. So therefore, generally very much welcome the discussion on liquidity in forward markets. And also to point out again that wholesale electricity forward markets are all about efficiency, liquidity, and transparency. It's not only liquidity, it's also efficiency. has already been mentioned today, and it's also very much about transparency. In terms of the actual paper, we've missed a more comprehensive analytical approach. We've already said that in the workshop last summer as well. And as was already pointed out today in a couple of interventions, this is a more complex environment. So we have also financial services regulation play into it. That's MiFID II, MiFIR, EMIR, and a few related files as well. We have now the ongoing EMD review, which is also open and may eventually change market design again. So it needs to be reflected against that as well. So we are also missing a more in-depth impact assessment. I mean, Martin already referred to that and said that this would be part of a possible further study, if not a legislative proposal. But we really think that there needs to be sufficient evidence. We'll come to that in a bit. We also do not fully agree with the problem assessment in the first place. So that's very important to understand. On a more critical note, so following these rounds of stakeholder engagement over last year, we feel that the feedback has not been sufficiently taken into account for the final paper on a number of fronts. And we also see that we're really trying to over-complexify the market structure and market design. Certainly the regional virtual hubs as a proposal, but also when it comes to forward market coupling with CFDs, market making with TSO support, FTR obligations, with full financial firmness, and the long-term flow-based allocation, which has already been mentioned today, but maybe not looked into detail. And then again, I mean, this process started off with a review of the FCA guideline, and now it's tackling all electricity forward markets. So that's quite a different dimension. I think the core is still there to look into the FCA guideline, but suddenly we've actually really expanded the scope, and it's going into a much broader discussion while still keeping this initial rather targeted focus. Next slide, please. Yeah, so to get back to the point about what forward markets are actually for. So we want to clarify again that forward markets differ largely from physical short-term markets. And the very purpose of financial derivative markets is to reallocate risks and to organize future cash flows. But, and as that was already pointed out in the question today, it's not about optimizing physical flows long-term. Would be unnecessary. And causes of liquidity issues can largely differ between bidding zones. That's a very important point. We do see different liquidity levels in different bidding zones. And we feel that this problem has been generalized in this very paper and does not reflect the actual complexity of the issue in an adequate manner. And there's also national interventions that do have quite a significant impact on liquidity, be it certain subsidy schemes for fossil, renewable and nuclear generation, regulated tariffs and other issues. That's also something that needs to be taken into account. And then in the absence of a well-functioning and liquid secondary market for LTTRs, locational spread products offered by exchanges can be traded in a continuous manner, complementing the continuous nature of electricity trading. That's already possible today and has already been partly reflected. And a coordinated assessment and hedging opportunities should be conducted considering already existing market-based hedging products. And here I can confirm that we have not had a very in-depth exchange with ACER over the issue. So ACER should certainly make use of the experiences and knowledge of relevant stakeholders and directly involve exchanges and other stakeholders in the process. It's very important to know that a lack of liquidity does not imply that the market has not effectively provided hedging opportunities. Low liquidity can also show a lack of demand for hedging in local markets. That's an important additional point. Next slide, please. Yeah. So today I only focus on one aspect, and the same as you have focused on, Martin, today in commenting on this paper. So it's the zone to hub model or option. So in the short term, the regional virtual hub model may risk a fragmentation of the forward market and consequently a fragmentation of liquidity, as some market participants may decide to hedge themselves against the system price and others to proxy hedge against a more liquid bidding zone through existing local spread products. So when trading these hubs in the short term, obviously you may risk quite a significant liquidity split rather than helping liquidity. So it would be a contrary effect to what you actually want to achieve. But it's also relevant for the long-term effect of such a hub model. So you really risk to structurally decrease liquidity. And it was mentioned in the questions, and you've already replied to it partly. I mean, ever since 2011, bidding zone split in the Nordics, we've seen a steady decrease of liquidity in the Nordic market. Although we have to point out that this is actually a proxy hedging at a hub, but not at a zone to hub model. So just an important technical distinction. So in just over the last 5 years, we've actually lost about 50% of liquidity in this hub. So that's very significant and certainly not a role model for the rest of Europe to help liquidity. There's more underlying issues related, but yeah, it's certainly not a role model to follow as such. Then the negative long-term effects will also have additional issues. So the transmission rights between the hub and the smaller zone within the hub will remain illiquid, since the same market participants that are interested or not interested in trading the smaller zone will be interested or not interested in trading the transmission rights. Any program to make these transmission rights more liquid can also be applied to the smaller zones in the first place, so you do not have to go through a hub model. Thus, creating a hub with transmission rights only transforms the problem without solving it at the expense of turning market structures upside down. So you put transmission capacity before market rather than the other way around. And an important issue is that there is no spot market that actually corresponds to the hub. That's the strong connection of physical spot markets and derivative trading that creates a perfect hedge to these spot markets, and that drives liquidity in these derivatives. And this means that the hub market might turn out to be relatively illiquid. And then the last one, and that has already been pointed out, I think it's the most popular question today, the German problem, or German-Polish problem, actually. So why, if trading in Germany and against the German bidding zone, would you move to hub trading? It appears not logical, and this would then take out significant bits of liquidity and then actually creating another problem. Martin referred to that as possibly creating 3 hubs in Europe, but if you were to take away all the liquidity from any future hub, it will certainly have quite a significant negative impact. So to summarize, we're not convinced. We think that this is complexifying the market design significantly. There are easier ways, and I know that EFET and Dioelectric will also tackle that in a second. But we're certainly not convinced about the suggested options.
Okay.
Thank you very much.
Sorry. Sorry, because you're running over time. I didn't want to break you up. Oh, I have an echo. Sorry, I'll go to the next speaker. Would I zoom is Jérôme? Just let me get the slide up.
Yes, absolutely.
Yes, go ahead, Jérôme, and please try to stick to your time.
I will.
Apologies for giving 5 minutes to Christian. No, that's okay.
Thank you, Mathieu, and good afternoon, everyone. I'm Jérôme Lepage from EFET, and we're doing this presentation jointly, EFET, the European Federation of Energy Traders, and Dioelectric. So if you go to the next slide, Mathieu, wanted to present our views on this policy paper, and especially a series of questions and worries we have about it. And to start with, I think the premise of the paper is not the right one. There's an assumption that the forward market doesn't work well. We're not saying it works perfectly. It could work better. That it doesn't work well, I think it's a mistake. To some extent, it is integrated. Market participants in less liquid bidding zones where there's a lower liquid forward market can have access to other forward markets. That's called proxy hedging. This happens way before the availability of long-term transmission rights in like the end of the year previous to delivery. So this is a reality today. There's a virtual hub, which is called Germany. There are multiple virtual hubs, also regional, but there's one that attracts a lot of liquidity. That being said, we're happy that there's a focus on this. There's a focus on forward markets in this paper. There's a focus on forward markets in the consultation of the European Commission and on electricity market design reform. And yeah, we believe that there's work to do. We want to make sure that the liquidity on the energy market improves. That's the heart of the question of forward markets. Long-term transmission rights, which can improve forward markets at the margin, with like improving cross-border risk hedging, can also be improved, especially with longer maturity and larger volumes of LTTRs allocated by the TSOs. Now, we do have quite a few reservations in terms of the solutions proposed, most of which got very low scores of support in the ACER consultation of last year. It would probably be interesting to see how this evolves with the new position paper. So maybe time for another detailed consultation and looking at what all the electricity experts think about those proposals on the table could be in order. But yeah, so risk around the role of LTTRs related to improving liquidity in bidding zones, the question of are forward markets integrated or not, and the different policy options that are proposed by ACER, all this worries us quite a bit. If you move to the next slide, Mathieu, I'll focus on three principal elements with which we have quite a few worries. The first one being long-term flow-based allocation of capacity. We've touched upon it, or colleagues from ACER have touched upon it. We're still quite uncertain and doubt the benefits of the allocation of forward capacity based on long term. First, because we're not looking at flows in the forward time frame. So wire flow based allocation. There quite a lot of uncertainties around the levels of capacities and worries about capacity levels at certain borders where the spreads are low. There also like strong questions around the implementation of this, and especially with regard to collateral requirements when it comes to massive auctions of rights across Europe. We've seen how that has limited already the capacity of market participants to trade forward markets of energy this year. So we don't want to add the question of collateral with regard to long-term rights to the one that we have already on the energy market. Now, the heart of today's discussion, I believe, is around virtual hubs. So I would definitely share Jim's comment earlier, Jim from NSOE, around the fact that we heard a lot of hopes. We've heard a lot of, we don't really know, we haven't assessed that, we need to go back to you, get back to you. We've heard no certainties. All this is based on theoretical concepts. There's wide dissent against the proposal from the whole range of electricity experts. And the only things or models that are close to the one proposed by ACER at the moment really don't bode well in terms of liquidity of energy markets. We also think that, so in addition to the virtual hub, the zone to hub rights, if I don't think we should call them transmission rights, because they wouldn't be linked to transmission as such. That's the question, like how it would be done. There's a hope that this will create a bridge to liquidity in the hub, which we doubt quite a bit. So all this for us, non-tested ideas and kind of examples that don't indicate the right direction. So we're really caution against this, and we're really worried about this, and we think further assessments, further discussions are needed. We want to see our real numbers on the table, and not just numbers about the expected hopes and benefits, but also looking at the different effects, not only on the issuance of cross-border risk hedging, but also on the energy market and on FTRs of the FTR. Yeah.
Can I ask you to finish, Jeroen? Maybe.
Sure. I thought we were allocated twice 5 minutes for EFET and Eurelectric.
Oh, okay.
Thank you.
Yeah,
I'll be quick.
Then Europex used your 5 minutes.
Okay, I'll be quick.
Go ahead.
On FTR obligations, this is an option on the table for us, but we need to make sure that this is only a possibility for TSOs to add to the to existing FTR option volumes. This is very important, and the goal there should be to make sure that market participants are given indeed a choice. We need to make sure about how those FTR obligation works for market participants, for TSOs, and that they're not one tool just to allow implementation of the virtual hubs model, which again hasn't been necessarily tested. So if we switch to the last slide, sorry. Insistence again on, okay, what you're proposing right now at the moment, we see this as a revolution. Sometimes revolutions are good, but we'd rather see a principles-based and tested evolution that actually addresses the issues at stake. The issue is increasing the maturity of the forward market, increasing its liquidity, and we're talking about the energy market. So there, making sure that we remove all disincentives to forward energy market liquidity, that we widen the scope of collateral. This is really important to allow market participants to take positions over years. Now, when it comes to the cross-border risk hedging, we'd very much support proposals around longer maturity, greater volumes, financial firmness of those rights, and their issuance at all bidding zone borders in Europe. Their secondary trading as well, and we need to see how this can be facilitated. And finally, and especially in illiquid markets, make sure that we stimulate and incentivize voluntary market making, and see how and what can be done with regulatory authorities in that respect, as well as TSOs and exchanges. So that will be all from me. So again, main message, let's try to stick to things we're sure about, assess the rest, and come back with a proposal that is properly tested and with a proper impact assessment made.
Thank you, Jeroen. I would quickly go to the next, which is Michael van Bossuyt from ACER.
Yes.
Correct.
Thank you, Mathieu. And you can go to, yeah. So, well, I'll make it easy. I just have one slide. And I can say that for IFIX, it's very essential to stress that forward markets are very important for industrial consumers to allow us to hedge our positions. And thus, we really appreciate the work that has been done by ACER and the fact that we are having this discussion today. And I want to stress again that forward markets are already delivering value today, and we must improve them. However, I'm not sure what's in it for us in what is on the table now, because I see a lot of extra complexity. I see a lot of extra risks, and I see a lot of extra costs. I mean, all of them are potential, but I mean, I don't see where the upside for us is looking at this. And I think, and that's why we added here some principles that are very important for IFIX. And it is that as much capacity as possible is given to the market as soon as possible to allow for efficient hedging. And I'm not sure that what is on the table now will follow that goal. And that's maybe a comment that I use a lot, but grid users, mostly consumers, pay for 100% of the capacity, and so the cross-border capacity. And for us, it's important that we get that and or get as close as possible to that one. And I'm not sure that this is actually going to do that because there's no link necessarily with the transmission capacity as such. Like I already said, is that for us, it's also important to have longer-term forward markets. To have a better alignment with the hedging needs we have as industrial consumers. And there, one of the risks we see in the proposal is that you might dilute liquidity over too many products and timeframes. And so you will need an efficient allocation mechanism, because if you start going to weekly products, but then most of them are not selected and yearly products are over-asked. So first, it's very unclear how you will ensure that we will not end up with less liquidity after doing the changes that are here included. And third, congestion income from TSO should be used in the first place to invest in cross-border capacity, in cost-efficient cross-border capacity. When I see a lot of issues about dropping firmness and those kind of things, all the cost risks that are involved there, I'm not sure that we're moving in the good direction. Moreover, for us, it's important that we're evolving towards market integration and not just market coupling. And the way you attack now the forward market functioning, we're not sure that this will lead to more integration. And so I see that you have some goals in the work that you have been done, but I'm not sure that we will reach that goal. And which is for us the real end goal, is to come to market integration. Then I won't go in too much detail into the long-term flow-based allocation, because you also have some other options on the table where we would like to see a little bit more what would be the real impact. So an impact assessment, how much more capacity would we get on the borders? Thomas, you showed some of the values there, but it's important for us to see in different scenarios towards the future, with more renewables, with more uncertainty, what this would mean for us. And if we would really go to a system where we get more cross-border capacity and not end up with less. And I know that you de-link a bit the forward transmission rights, I would say, or the LTTRs with the real physical transmission rights. But in the end, it's always physics. Huh? So you have to get something over the border. And there we have really some questions. And then for virtual hubs, up until now, you have not convinced me that it's not a magic bullet. And I'm afraid we might end up with a situation that is worse than now, because you look at it from a theoretical perspective and ceteris paribus analysis. The problem is that ceteris most of the time is not paribus when you start doing changes, because positions and behavior will change. And so that's for us a bit the main message. We really appreciate that you're working on this. I mean, there needs to be some improvement, but we don't really have a clear enough view or an impact assessment to see what would be the possible consequences. And as consumers, we know that in the end, if something goes wrong, we pay the price for it. And so we really need some more forward market improvements. We need some longer term maturities. We need a better match between our hedging needs and what is offered on the market. But we're not sure that this will bring it without a huge cost for consumers. And we see some risk, we see a lot of complexity. We also see and hear all the questions from other markets and market parties. Sorry, and so that's where we as IFIX still have quite some concerns. but we're open to continue the discussion here. And we see some value in the theoretical concepts you bring, but we would really like to see this translated to a more practical hands-on approach and see a real assessment of what this would mean for us from an economic perspective. And with this, Mathieu, I think I respected my 5 minutes.
Yeah, definitely. Thank you very much, Michael. So indeed, apologies, we're running a bit over time, but I think we sort of caught up a bit. So we're down to the closing part of our workshop today. And first I would give the word to Anne Rademek from the Commission. Anne, I hope you're there. Yes?
I am there.
Hope we can hear you. Yes, we can hear you as well. Okay, perfect. So yeah, the floor is yours. And then Christian, please take over right after.
Very good, thank you, Mathieu. First of all, I think I would like to thank the ACER for the valuable input to the debate. What I can say, I'm sure that you are all very well aware of the ongoing reform of the electricity market design. The proposals from the Commission will be out very soon, probably in the coming days. So at this stage, I cannot say anything about those proposals. What I can say is that those proposals are going to be subject to ordinary legislative process, so with co-legislator. And with regard to a more long-term planning, so it's still on process. The idea is to finalize the proposal on electricity market design, then to work further on the revision of CSCM and NFCA guidelines. So that's probably what I can say about the process. Now, on substance, and with regard to the forward market, I can only acknowledge the importance of this work and the importance of having a forward market that function efficiently and that offers enough liquidity to all European market participants. The Commission did ask a question about the liquidity on the forward market in the public consultation related to the reform of the electricity market design. We observe that the forward market is liquid in many bidding zones, and we are carefully listening to the proposals and to stakeholders' view. A liquid forward market is also a pre-requirement to the implementation of other potential measures, which could be designed in order to protect the end consumer. So it's really a very important area. We see that the lack of liquidity in the forward market forced many participants to proxy hedge themselves, using another bidding zone as a proxy. We also see that some bidding zones are currently subject to a review process. And I think Martin explained very well the interaction between the bidding zone review process and the liquidity. So yes, the forward market is definitely an area worth looking in the context of the review of the electricity market design, and we believe that there is probably room for improvement. So I think we have looked into all options on the table. As I said at this stage, I'm not in a position to comment on the proposal that the Commission will table by the end of this week. I mean, it's coming in the coming days. So I cannot comment on substance, but we can clearly acknowledge the importance of having a liquid forward market available to all European market players. Thank you.
Thanks, Anne. Maybe I can take over if it's okay. We're 3 minutes past the hour, so I will just try to wrap up with a few closing remarks. I joined you roughly midway. I've been traveling, but importantly, I also heard the stakeholders' views here towards the tail end. Indeed, I mean, a few takes from my side, echoing that of the team. I took significant appreciation of the discussions that improvements are needed. Probably some differences as to what to emphasize in terms of reform. This notion that something new and unorthodox, if you will, may meet the ask for more empirical evidence, which can be tricky when something is new, but also an ask to continue discussions and try to translate that into more practical benefits, I think was the term from our IFIEC representative towards the end, which we very much agree with. So there's a process ahead. Obviously, we'll all be looking forward to, as Anne was signaling, what comes this week from the Commission in terms of the broader market design reform. That's not the end of the story, obviously. There is an FCA regulation change process up ahead. It'll be triggered by the Commission, and we will be eager to play a role alongside stakeholders in that. So it's maybe a 2 or 3 step process up ahead. You'll note the question marks in the timeline here, indeed, which I think is the safest thing to indicate. But this is certainly not the end of the process. We are eager to engage with you in the coming months, multiple months ahead. So I would say from my side, thank you for your participation. And I think we all recognize it's a hugely important issue and there are further discussions to be had up ahead. So thanks a lot. Mathieu, Martin, Thomas, anything you want to say at the tail end?
No, I think maybe the only thing I would say is we had the poll, of course. So I think it got a bit between the door of time, but we'll publish the results with all the reports and all the information for people to have a look there. And we'll of course also answer the questions, any questions that are still open. So I think with that, we can close.
Yeah, one final thought. So we are still open for any bilateral discussion with stakeholders. We may initiate some of that as well, because I see there's still a lot of room for discussion and clarification, and we are open to that. Always open. Yeah.
Sounds like a good to close it with.
Yeah.
Okay.
Thank you.
Thank you. Bye bye.
Thank you very much.